Hi there, this is Matt Curfman with the Richmond Brothers here for your May 2019 edition of Matt's Minutes. Well, if any of you actually opened up Fidelity and looked at your statements for the month of May, you probably found that just over the last 30 days, values, especially in the equity bucket, had come off from the numbers at the end of April. So just because things have come down a little bit does not mean that we're tipping into recession, that all is lost, that we should panic and sell. So I just wanted to put that perspective out there. When you look at broadly some of the markets, the Dow Jones, the S&P 500, and on the other side you go to the aggregate core bond kind of as a benchmark. So if you look at just the month of May, the S&P and the Dow had dropped around 6 or 7% from their highs, which seems like a big swing, but remember they were quite positive at the end of April. If you look at aggregate bonds for the month were up 1.5%. Now, if I then take that year to date, so go back to January 1 all the way through the end of May 31st, and the S&P is still up roughly 9%, the Dow Jones is up roughly 6%, and aggregate bonds are up roughly 3.5%. So even though we've seen some of those benchmarks come off of their highs 6 to 7%, and just recently we saw the NASDAQ, which is more tech heavy, fall into correction territory. What does that mean? It's come off of a 10% drop from its high, but it's still quite positive year to date. So I wanted to put that perspective out there. It's only a few days into June and we are seeing some positive relief. There's still a lot of noise out there when you look at headlines specifically around US and China and NAFTA and then trade deals with Japan. So it still seems to be government is the topic of most interest and of most concern, and that seems to be driving some volatility in the market. So I would kind of take a step back to those of you who had attended our seminar in March in early April, where we kind of said we do think we have the opportunity to have some growth this year. We're not necessarily looking for home run returns, but we don't think we're going to tip over into recession yet either. Now that the Fed has paused their interest rate hikes back in March, I think the question will be as we move through the second half of the year, does the Fed keep flat on interest rates, or do things slow down enough that for whatever reason they actually drop interest rates? So we would still look out into 2020 and suggest that between 12 and 18 months from now, that there could be reason to tip over into recession. It's not going to be one thing, it's probably a number of different things. So as we look and continue to look at your portfolios and talk to all of you, for those of you that are drawing income, we want to continue to shore up and make sure we have money markets and liquidity for low duration bonds, things of that nature that shouldn't be impacted if the market falls over. Whenever possible, we want to look forward 6 months, 12 months, 24 months, and have a forward number of periods for your draw so that you don't have to dip into that equity bucket when prices are off, and we can let the equities ride through. Now, ultimately, if we have a position where we find ourselves where the equities have risen enough this year or early next year that we want to skim off the top, I think that strategy would still be a good strategy as we move forward. And so that's something you'll continue to see and hear more and more from us here at Richmond Brothers. The other side of it, whether you draw income or whether you don't, if we want to shore up safety nets, there's a lot of different creative ways to do that, whether it's through money markets, CDs, fixed or stable annuities. You can use those for income or you can use those for just safety nets, kind of putting a floor under some of the portfolio. So those are things we'll continue to look at. Again, we do not think the economy is tipping over into recession. We think it could eventually happen. That said, volatility is probably here to stay, and we've talked about this almost every month on Matt's Minutes, so we expected it. It's here. Now the question is, how do we respond as we continue to move throughout the year? So I think the other thing with working with each of us and working with Richmond Brothers as a team, make sure and bring up questions when you talk to your advisor on risk-alize. And so I think it's important to look at your tolerance relative to the overall portfolio compared to how your portfolio is invested, and if possible, can we bring those numbers together if they're not already in line. So with that said, I think hang tight through the month of June. We'll see what comes out, and if we do see some path forward with the U.S. and China, we do think that will create a bit of another relief rally. And the other thing mathematically I want to leave you with is if we do have all of the tariffs implemented both to China and from China, you're talking at tariffs on goods and services that are about $500 billion going one way, about $130 billion going the other way. Now again, taxes on these goods are being increased. That's not a tax of $500 billion. Compare that to our economy, which is roughly $14 trillion. And what you're really looking at is, would these tariffs and would these things have an impact where, let's say the economy, GDP, was growing at 3.5%. Could we eat into that 0.3, 0.4, 0.5%? And would that lower GDP? Probably, but would we still be growing at 3%? Very likely. 3% is still a really strong growth factor. And so that's why we don't think in the near term this will tip us over into recession. Now, the longer this drags on and the more headlines it hits, we want to pay attention to the mathematics and the logic that say we're not tipping into recession, but also how people feel and how people respond with their money. So we'll keep an eye on that as we move through June, and we appreciate having the opportunity to work for you. And as always, if you have any questions, thoughts, concerns, we can help you with. Don't hesitate to call or email questions@richmondbrothers.com. Thank you so much for tuning in, and have a great start to your summer.